Hello and welcome to the latest in Mortgage Solutions panel debates, this week in association with Coventry Building Society. I'm Kay McClellan, Features Editor of Mortgage Solutions, and this week we're going to be discussing the issues around buy-to-let and regulation. Buy-to-let is seen by many as the great hope in an otherwise flat mortgage market, so is the hype justified, and what kind of developments can brokers expect? Joining me on the panel today to discuss these issues are Kevin Purvey, Head of Intermediary Sales at Coventry Building Society, Ben Thompson, Managing Director of Legal and General Mortgage Club, John Cupis, Managing Director of PMS, and David Hollingworth, Associate Director of London and Country Mortgages. Thank you all for joining us today. Kevin, if I can come to you first. Buy-to-let lending rose to around about 14 billion in 2011, and some experts expect it to get to 20 billion perhaps in the next few years. Where do you see the buy-to-let mortgage market going?
I think the buy-to-let market has been incredibly robust. I think it's driven by a number of factors. I mean, clearly the lack of social housing, first-time buyers entering the market much later now because of demographics. They're worried about jobs maybe as well and want to be flexible in their approach to where they decide to live. And I just think the general economy has made people think that maybe they will buy later in life and maybe do things that they want to do now rather than later. So I think that that's, if you like, that demand will continue to drive the buy-to-let space, and I think it's really good news.
Ben, do you think that 20 billion is a realistic figure for within 3 years' time?
Yeah, it feels realistic because of the factors that Kevin mentions, and I think the market at its peak was probably some 43, 44 billion back about 4 years ago, so 20 doesn't sound a lot in that regard. I think one or two things looking out into the future, maybe 2 or 3 years down the line, certainly not now, is when house prices start to recover and go up again in real terms. It's amazing how quickly people forget that renting's a good idea. When friends are seeing the house prices rise, etc. So I think in time when confidence comes back, rates possibly start to rise 2 or 3 years down the line. Things might change a little bit, but yeah, 20 billion feels okay to me.
And John, I mean, do you think that the sort of hype that is around buy-to-let is seen as one of the few kind of rays of hope, I suppose, in this market? Do you think that, given the size of it, that it is something brokers should look to?
Yeah, absolutely. I mean, I think buy-to-let is one of those sort of self-regulating markets because when house prices are flat and lenders are struggling to get the criteria because funding and pricing constraints mean that residential lending is tough. Buy-to-let takes up some of the slack. And renting becomes, has been more affordable, although under pressure now. I think that we are still fundamentally a house-owning democracy, and the aspirations for house buying is still there, particularly for first-time buyers. And I think that's reflected in some of the government initiatives to promote new build and the MIG support schemes for higher loan-to-value lending, and we will see more of that. But I think in this point of the cycle, I think it's going to be quite difficult for buy-to-let sort of disappear in favour of some of these schemes. I think you'll still see a healthy buy-to-let market, but perhaps tempered by some innovation from the government and lenders to promote higher loan-to-value, particularly for first-time buyers and for aspirational young purchasers.
And David, what kind of developments do you think brokers can expect to see in the next sort of 1, 2, 3 years in buy-to-let?
Well, I think in the short term we've seen more lenders coming back to the market, and I think that's as much as we can hope for now. Increased level of competition that has seen an edging out in terms of the maximum loan to value that's available on products. So 80% is becoming more common now, albeit you're still going to pay a price for that. And I think this isn't going to just suddenly explode, and we'll see it pushing back to 90% that perhaps we saw in 2007. But gradual, slow improvement in competition should bring better criteria as well to play.
Well, you mentioned obviously the 80% LTV. I think 6 lenders now lend up to that point. I mean, Ben, do you think that that's going to become the norm in the years to come? 80% will be the maximum and the sort of the top level that buy-to-let investors can expect? Yeah,
it feels like where it's settling at the moment. I think, as you say, there's 6 or so at the moment at 80. Will we get 85? Yes, I suspect we will. That would not surprise me at all. But I think the market's learned a lot about the risk in terms of the private rental sector and buy-to-let generally. So I think the market is now very well understood through stressed environment as well. So I don't see it going much further than perhaps the levels we're looking at the moment. But yeah, 85% possible, but 80 feels like where it's settling at the moment.
There's unlikely to be a big rush to push that further and further, I think. The attraction for lenders is that big deposits, decent margin, still people aren't going to be pushing out that risk, I don't think, in the very near term.
think you're right. I think it depends on the lender's attitude to risk and where they sit within their portfolio. I suspect you may see sort of new entrants as that's where they go first in terms of trying to provide a USP to their offering and going up the LTV curve maybe, and maybe more the traditional people that have been in it for a while and got large books, maybe taking a more measured approach to that.
You mentioned new lenders. I mean, do you think that further lenders will be coming in 2012, for example?
I mean, I think if there are new entrants to the market or people looking to expand portfolios, then clearly buy-to-let is an area where people will look. But I think you've got to look at that against your own risk portfolio and decide where you want to play. And if you're going to come to the market, you've got to offer something different. There's no point in just offering the same criteria as everyone else. So it still presents its challenges, I think, but it's a possibility, I think.
Well, John, I mean, Kevin mentioned the idea of differentiation when a lender is looking to launch into buy-to-let. Where do you think it is that new lenders potentially might need to focus?
Well, I think new lenders, Kevin's absolutely right. They do need to differentiate. I think you will actually see some movement up the risk curve, particularly from new entrants. I think also we've got a very underserved professional landlords space. There's still some work to do there. I think from lenders looking to bring in more property into lendable portfolios, which we haven't seen as much of. But that's just where we are in the cycle. I think lenders are quite cautious about their exposure to professional landlords. Although many of the lenders would probably say that the criteria they're using to assess professional landlords and landlords generally is still very, very good compared with the owner-occupier sector. So there's a couple of areas there where I think you might see lenders innovate.
Where we've seen bigger lenders come back in, say the likes of Abbey and Accord, representing the Yorkshire stable, they've been quite cautious initially, and then we're starting to see their criteria push out as they grow their appetite and feel that their systems are ready to cope. Where you might see smaller lenders is getting into niches like, I think, portfolio lending, and they could just do something not especially risky, but just pushing it that little bit further. You don't have to tweak criteria that much, I don't think, to differentiate in this market.
So are there any specific areas you think that brokers themselves need to be focusing on? John?
Well, I think it is about finding the right client to invest in this market, because you've got to find or have an understanding and appreciation that it's not a risk-free investment, and you've got to be buying in certain sectors. It's not always about huge capital appreciation. It's about generating the right yields and buying in the right spots and having a complete understanding that we still treat this as a regulated activity. It's still a professional and advised sale required for most customers. But it's about understanding that you should be in this for the long term. This is not a short-term investment as it used to be. You're buying rental properties ideally for a good long-term yield and ideally some capital appreciation, but that shouldn't be your start point.
It's interesting. I mean, just picking up on that, what we hear is the perception about buy-to-let is wrong amongst many customers and customer banks, if you like. So I think a lot of it's about just communicating to existing client banks what you can actually do as a potential borrower in the buy-to-let market. Because a lot of people think the market's just gone, along with the credit crunch, it's just disappeared, or the terms are so restrictive you can't get into it, or what a high yield means compared to putting money in a bank or building society. So there's a lot of really simple stuff that some people are just doing very, very well to generate business with the current criteria and product ranges that are out there today. And clients just need to be told about that regularly.
And Kevin, from a lender's perspective, do you think that there are certain areas that brokers need to be doing more on when it comes to buy-to-let?
Well, I think there's remortgage opportunities. Certainly the CML stats bear that out as well. So I think moving forward, as books mature and people come off, if you like, incentive products, there's an opportunity there to go back and look and see what opportunities you have got. Because as Ben says, the market is there, and there are lenders that are keen to lend, and there's good opportunities. And I guess it's also just looking for new business as well, into letting firms and making sure you're making the most of those opportunities. So it's sort of looking further afield and just being wise to where you can maybe create opportunities and help people.
Well, on the product front, I've heard brokers complain often about the high fees that buy-to-let products have. I mean, David, do you think that that is a justified criticism?
I think it's horses for courses, really. Some investors will quite like the way that the big fees can drive down the rate. They'll use that, and they can often add the fee to the loan. Whereas many, if you're getting into 1 and 2 property landlords, they'll very much approach it as they would their own mortgage, and they'll just want a good deal, overall cost. They want value, and to that end, they will look at the fee structure and often bulk at fees that can be 3.5%. But as Kevin says, remortgage is a big market out there. Lots of products are offering incentives on free valuation, free legals, just as we've seen in the owner-occupier market. So there's good products out there, and to suit anyone, no matter what they're looking for.
I think you're absolutely right, and I think it's about product choice. So it's a range. I mean, percentage fees aren't for everyone, but flat fees are, and it's actually down to the advisor to take the client through the myriad of products that are out there and advise accordingly. I mean, Coventry have product fees as low as 250 with a range moving forward. We don't tend to play on the sort of percentage fees, but again, that's choice, and it's down to how you want to price your portfolio. But come back to that's what the brokers are there for, to advise customers.
Yeah, and having that choice is a good thing.
Well, moving along, the European Parliament has suggested that they want to bring buy-to-let under the umbrella of regulation. Do you think that this is going to have a negative impact, or will the market continue regardless, really, without any sort of negative effect, John?
I think it's quite a difficult one, this one, because the market in Europe for buy-to-let loans is completely different to here. So I think whilst the European Parliament and would like to have a flat and consistent market, I think it's quite difficult to expect that we are going to end up with a consistent market across the UK and the rest of Europe, because the markets are so different. I think the UK has always led the way in regulation. We actually have an unregulated buy-to-let market here, but we treat it as regulated because we think we're doing the right thing. I think it's going to be very difficult to get consistent regulation across the whole of the market. When in Europe, for instance, rental is much more the norm. People buy much later. Here, we buy much earlier and rent. We're starting to see more rent, but even then, I think aspirations are still, for owner occupation, are still high. So I'm quite nervous that we'll actually end up with consistent regulation.
David, do you have any particular concerns about this side of things?
I think on the face of it, it shouldn't cause a major problem. I think most brokers approach buy-to-let in exactly the same kind of process that they apply to regulated business. Most lenders are already going to be authorised. So on that regard, it shouldn't cause a major problem. The thing is, I think, like John said, you need some common sense in how it's applied. So will it be viewed in the same way as for affordability, for example? Suddenly, are we going to move away from looking at the rental that it generates and get into this situation where they need to be showing they can cover the mortgage from income? Those are the kind of things that would be really problematic if a kind of just one size fits everything was tried to be employed. But in theory, I don't think it would make a major problem.
I mean, Kevin, is this an issue that you've looked at particularly as a lender?
Sure, we're certainly aware of the regulation or potential regulation that's around the corner. I sort of share David's view. I think if the market was allowed to carry on with rental yield calculations as they stand today, effectively every lender in the country is operating it as a regulated product in terms of as it goes through product design, TCF, the risk, the way that everyone manages that, it's effectively treated as a regulated product. What you're fundamentally talking about with European regulation is maybe a fundamental shift in terms of how that's brought to market, and that obviously needs some careful looking at, and would obviously change the dynamics. So from our point of view, we're very close to that, and seeing, watching brief.
And I guess the only thoughts from me is the bigger it becomes as a market, the harder it is to actually keep it outside of scope and call it niche. And it's obviously starting to grow again, so there comes a point, isn't there?
So do you think regulation is perhaps inevitable?
I had similar views to David, I think. I mean, I come back to my point actually previously, which is I think they just have to treat it very, very carefully, because in the absence of any other obvious funding, the private rental sector is playing a very, very good role in society at the moment. So I just hope that proportionate and sensible approach is taken. The other side to it, if I'm an intermediary writing business today, if the buy-to-let market suddenly becomes difficult, what probably happens is the residential owner-occupier market starts to grow again, and actually that's okay.
Obviously, the biggest piece of regulation that we have seen recently is the FSA's final paper for the mortgage market review and the proposals therein. And there's been lots of talk around about interest only and its final actual proposals that it's given to the market. Do you think there's any danger in interest only and the crackdown that we've seen from lenders filtering into buy-to-let in any way at all? John?
Well, the MMR does cover a lot of ground other than just interest only, but I think the interest only will, it's a big part of the buy-to-let market. I think we've got to get through MMR first for the regulated sector. So it's is a regulated activity. Buy-to-let is unregulated at the moment. So yes, there's always a danger that the interest only rules could come across. But let's say it's a big part, so I think who knows. I think that for clarification on the MMR for residential mortgages, it does look like that interest only will become a small part of the market. I think that's stated intention from the FSA. They don't want to see it become the norm. They've talked about it being niche, and they want lenders to take very close care in terms of any repayment vehicles and that will be attached to those loans. So I think from some of the indications we've seen from some lenders in the last few weeks from the mainstream market, it's clear that they are already looking at it as a minority product, or certainly a less popular product. So I think we'll see.
Yeah, and I agree. And I think it just creates opportunity in some respects as well, because it's certainly not being outlawed. Different processes, different costs, different risks, different experience in terms of underwriting, you could say. So it's not inherently much more risky. If I'm a lender, I don't feel my loan's at risk necessarily if I'm lending at 60% LTV on interest only. It just means the checks and balances I have to run are much more detailed and comprehensive. So I potentially see a market where it's priced for risk. Probably a loaded interest rate for interest only, and it's taken up by the specialist lenders or some of the lenders on the periphery a bit more. I don't see that market completely disappearing. The other thing I'll just add very briefly is there comes a point where a customer has to take responsibility. And this is a theme which doesn't necessarily come out for me. I think if you borrow money, most people understand you've got to pay it back. And there has to be an element of understanding around that, I think, in terms of consumer responsibility. That's the only point I'd make on interest only.
And Kevin, how do you view the future of interest only as a lender?
Again, reviewed the MMR, as has been said by colleagues here. I think it's one of those issues where I think if you look at it, it's criteria based. It's just another piece of criteria that lenders have got to interpret and decide where they want to sit in terms of risk and how they're going to manage that, as Ben said. And I think there's a risk reward for that in terms of price, maybe in terms of how you might administer it, because clearly there is more burden on lenders to look at the repayment vehicles at some point in the life cycle of the mortgage. I think, echoing John's points, I think the FSA have been very clear in that it is a niche product, and they expect the vast majority of mortgages to be done on a capital interest basis. So I think what you've seen lenders do it throughout the market is effectively reflect that criteria and reflect that direction of travel. Will it move and will it flex a little bit? I think there's probably still a little bit more to go as people get comfortable where they're sitting on, and you've got to look at your criteria based on your own experiences and where you want to be from a risk perspective, and you've also got to look at it against where you sit in the market.
I mean, having said all of that, I think let's just say MMR hasn't started yet. I think we're still in consultation phase. We're talking about rules in the next year. Could be several years before we see the full implementation. I think capital issues may change, the market may change. And there's plenty of innovation opportunities for lenders. Ben was talking about pricing for risk. Absolutely. I mean, it's not dead. I think it will just change.
And Kevin, taking the broad view, do you think MMR is a good thing for intermediaries specifically?
I think it is. I think the definition about advice and lenders' responsibility to check affordability, I think is good clarity, and I think the market needed that. I think from the intermediary space, Clearly, advice is welcomed. I mean, all the reports that I've seen, people like advice. They're scared of the high street banks about what's happened over the years, and you can see more and more people wanting and needing advice in the future. Clearly, Coventry intermediaries are aligned in terms of our strategy to the mortgage market via intermediaries, and we see that continue to grow, and we'll continue to support them through our pledges.
Ben?
Yeah, and I think supporting that, I think there's a real job for the industry to do to raise the awareness of what it is an intermediary does. It's more choice, it's efficient, it's easy, it's often best price as well. And I think we should proactively promote that as an industry. So I mean, I take the MMR proposals probably create a market where the barrier for entry is a bit higher. It's probably tougher to write business, there's less business to write, and it's increasingly seen as a more professional industry. And I think all those things are good for the sector. I just think it's now probably time we shouted a bit more loudly about what it is we do as a sector and made more consumers aware. Whereas I understand something like 40% of people would, at first point of choice, choose an intermediary over walking into a bank, and that just doesn't quite feel right to me. So I think there's a job to be done there.
The FSA has obviously decided that it's going to prioritise implementing the MMR proposals above introducing the individual registration regime to the mortgage market. Do you think that's the right move, David?
I haven't heard anyone who's got a word to say against individual registration, so it would seem like the obvious thing to get that implemented as quickly as possible, but that's clearly not the way it's going to go, which we just have to deal with, I guess. But it was still there, it will still happen, I hope, and I don't think anyone is against the proposal. So
I think it's the biggest disappointment of MMR that that's not been put in place almost, if you look like as part of phase one. I think it's a big disappointment.
Well, obviously, they originally said that they were going to begin introducing it from 2011. Are you quite surprised that they've chosen to delay it for as long as they have, John?
Yeah, I mean, it was right from the start. For me, it was the number one benefit. For intermediaries in terms of, for the first time, registering their professional status as an intermediary. And secondly, for the lender, particularly lender concerns around managing who you're dealing with, fraud, and all of the unfortunate consequences of bad advice and poor lending. It would all have been encapsulated within a single registration system, which
yeah, absolutely.
Totally agree.
Absolutely, it would all have come together, backed up by a good forward-looking regulatory framework, managed in a sensible pace and the rest of it. So, I mean, I'd be interested in Kevin's views, but I mean, I thought from a lender's point of view, this would have been fantastic.
I think the ability to eradicate rogues in the industry that tarnish the vast majority would be something that everyone would welcome and want to see sooner rather than later.
Well, thank you very much for offering all your views today. Kevin, Ben, John and David, thank you for coming in and joining the panel today. And thank you for joining us. Don't forget that you can take part in the debate at mortgagesolutions.co.uk. Until next time, goodbye.